I am Mark Lund, author of The Effective Investor. Now, this past year, we constantly heard the media reporting that the market's up and referring to the S&P 500. And when it's the S&P, everyone notices. They notice due to the media spotlight and because it makes up a disproportionate percentage of many poorly diversified portfolios. The S&P is a broad benchmark of 500 stocks. If your investments are lagging this broad benchmark, you may be asking a question such as, the market is up and I am not. Why? Well, the short answer is that the S&P is not the overall market, but rather a portion of the overall market. This portion of the market is hardly indicative of the market. The market includes both domestic and international stocks. It contains large cap, small cap, micro cap, value, growth, emerging markets, emerging small, emerging value stocks. So additionally, let us not forget about fixed income. Now, a closer look at how each section of the market did in 2014 gives us a better insight. So for example, the S&P went up over 13%. The Russell 1000 value did over 13%. Russell 2000, 4.8. Russell 2000 value, 4.2. International large company down -4%. International value down almost 5%. International small cap down 4.6. Emerging markets down almost 2%. And the U.S. government or fixed income about 0.2%. So keep in mind that the S&P serves as a kind of a Wall Street shorthand. The media watches it constantly because they believe it provides a good gauge of how things are going during a trading day, a week, or even a year. But still, the S&P is not the whole market, just a portion of it. You can say the same thing about the Dow Jones Industrial Average, which includes only 30 companies and isn't even cap weighted like the S&P. It stands for about 25% of U.S. stock market value, but it's devoted to the blue chips. So here's the point of today's video. Whenever someone sees a sector of the market performing well, they naturally think that this is where they should be invested. This creates a false illusion of how to be successful. When this happens, people can make the mistake and chase after the hot sector. Will it continue? Maybe, maybe not. They tend to forget that risk works both ways. Now that the S&P has appreciated, there's a legitimate risk that this ride is over, and that any material change to shift resources in this direction may be poorly timed. This is the risk of market timing. There's always asset categories that perform well. We just never know which one is going to be the best performer. Hindsight, investing is always best. So it's only natural that a portfolio that is heavily weighted in large cap stocks would outperform a diversified portfolio when large cap stocks perform well over a short period of time. So during any year, you're going to see certain segments of the market perform remarkably well and others poorly. Because of that ongoing reality, you must stay diversified and adopt a long-term perspective as you invest. So for example, our portfolios have 19 distinct asset categories. They are designed to not be dependent on any one specific asset class. This lack of dependency is designed to attempt to maximize returns for a given level of risk. The goal here is to get an overall market return. Now, this approach is designed around risk mitigation and is insulating clients from the downside risk associated with holding one or just a few asset classes. The consequences of this more prudent strategy is that investors should not see returns that are associated with the lowest performing asset class, and to the contrary, it would be unreasonable to expectation of investors to be getting returns associated with the highest performing asset classes. Now, the perception of underperformance or not seeing portfolio gains like the rest of the herd most certainly is inevitable and can lead investors to feel the need to react and make changes to their portfolio. Unfortunately, this strategy is exactly the wrong approach. Just like I've said many times, it's not prudent to make long-term investment decisions based on short-term returns of one investment or an individual asset class. If you have any questions about your investments, please feel free to call us anytime. or download one of our free reports. Well, that's it for today. Thanks for watching.
Baby.